We're going to jump in and look. This happens to be the Seattle Times today, and it's from July 27th. So just this last week by Chuck Jaffe. Now, here's the funny thing about this article. We read all kinds of things. People come out with all this media about this new app, that new app, what you can do with your money. And one thing I really like is that what Chuck Jaffe covers in this is, one, he talks about the fact, do not just sit there and look at every new app or the ups and downs of the market, because you're going to drive yourself bananas. It'll speak a little bit to what we're going to cover in today's podcast. But this is the key of this article, is that we all hear about this app called Robinhood, where you can trade stocks and it doesn't cost you anything. And that seems like it would be a really good idea. But what we're going to do is scroll down in this article, because I want to point out one specific thing. While Robinhood has created appropriately and effectively downward pressure on all trading platforms in terms of individual cost, how they're paying for it may not be so clear. One way to think about it is that he puts in the article, if you are not paying for a service, you are the service. Now the question is, who are you serving? And he speaks to that. Is even though Robinhood is now valued at billions and billions of dollars, etc., Robinhood does this. I'm going to read directly from the article. There's also something called payment for order flow, where brokerages or a brokerage gets paid for directing orders to different parties that execute the deals. The brokerage firm receives a small payment, often a penny per share, as compensation for putting the trades in certain directions. Robinhood, in a statement that came out last year, quoted its payment for order flow revenues at 2.6 cents for every $100 traded, rather than quoting a traditional price based on each share traded. So it makes it hard to know if Robinhood is making more or less than other brokerage firms. Some detractors have said it's much higher than the norm. Now, regulators are working on trying to eliminate some of this payment for trades and to really squash down some of the things that really create cost, whether that's potentially cost inside Robinhood or cost inside major mutual fund companies that are not fully disclosed. Again, regulators are working on it, but this is the key. The point for the customer at Robinhood is that professionals are lining up for the right to trade against you, meaning there's all kinds of professional traders, market makers of some sort, that are lining up to handle the trades when you want to buy something or you want to sell something. You think about this very simply. Anytime you buy or sell a stock, there's someone on the other side of the transaction who disagrees with you. Very simple. I want to sell a stock. Somebody else is willing to buy it. I'm selling it because either it could be life circumstances or why I want to sell it, or it might be I think it's going to go down. Most of the time, people are not trading for the life circumstances. They're trading for the potential gain. And when they do that, it creates this environment where you're competing against a trader who may be way better educated than you are, who does it full time, who has unbelievable amounts of computing power behind them and research departments. And they are on the other side of that trading transaction with you. And he makes a very cute metaphor. As a trader, you want to trade against people who aren't informed, and you want to avoid traders who are the most knowledgeable. That's not what you get when you trade on an app like this. But this would be like the NFL saying it wants to save money, printing its playbooks, and learning it can get those costs reduced to zero. All they have to do is use a printer run by, say, the opposing team. In this case, he uses the New England Patriots, a team that it's scheduled to play. Well, it'd be great to save all the money on your playbook, but it may not be worth it when it shows up to game time. It might feel great to simply reduce costs, but if that reduction in costs is putting you in a position that you're trading against the very best people out there and maybe not getting trade execution the way you'd like it, etc., I don't know what all the downsides could be. We would obviously say it's important to have a coach or advisor there, and it's impossible to create an academically allocated, globally diversified portfolio, or nearly impossible, for it to have 13,000 different positions and rebalance and screen when companies go from being a small cap up to a large cap, and do you get them out of the portfolio? All the things that have to go into true portfolio management are not likely to be able to be done on a phone app with your thumbs for zero cost trading. I hope you enjoyed today's video. Thanks for watching. Be sure to subscribe to our channel. ring that bell. And by the way, make sure to share this video. I don't know if you know this, but my cyborg body runs 100% on YouTube views and likes. Please don't let my batteries die.